Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, June 26. Trump says the war in the Middle East is over. Oil prices consolidate after a 15% decline since Monday. The US dollar is weaker as Powell's reluctance to cut the interest rates is countered by the rising possibility of a premature appointment of the next Fed president, while the US stocks are at record high levels again. What could go wrong, right? So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the US President Donald Trump denied earlier intelligence reports from his team that the US bombs in Iran caused only limited damage to the nuclear sites. He said, on the contrary, that the operation was a historic success and called the end of the war in the Middle East, except that it could maybe restart soon, he said. But the US and Iran are reportedly scheduled to meet for diplomatic talks on the nuclear issues in Iran this weekend, and that's an additional sign that Donald Trump really wants to de-escalate tensions in the Middle East. So, US crude is consolidating near its 100-day moving average level this morning, and that is a touch above the critical $65 per barrel level, which is the major 38.2% Fibonacci retracement on this year-to-date decline and distinguishes between the latest rally in oil prices and a return back to the bearish trend that has been building since the start of this year. And remember, pulling the geopolitics out of the picture, the supply and demand dynamics in oil markets remain in favor of softer oil prices as global demand prospects are weakening due to the tariffs and the trade uncertainties, and supply is ample thanks to faster oil restoration plans from the OPEC Plus countries. In this context, Russia said yesterday that it is open to another round of output hike at the next OPEC Plus meeting that is due July 6. So, if the Middle East tensions are done and dusted, oil will more likely than not return back to and probably below the $60 per barrel level in reaction to higher supply and still weakening demand prospects. This is good news for the Fed's inflation battle, of course, but it is not the only risk factor in town, unfortunately. The real risk to US inflation today is tariffs, and we don't have much progress on that front. The Federal Reserve Chair Jerome Powell keeps saying that the United States does not need to rush into interest rate cuts before more clarity on tariffs, but no one really listens to him. Even less so as there is a major risk that Donald Trump appoints the next chair Fed prematurely to give investors a chance to bypass what Powell thinks, because Powell does not want to cut the interest rates and he should normally stay on board until next May. But if Trump could appoint someone else, that would be great, and the market could start pricing in the new Fed chair, who will, of course, be willing to lower the US interest rates to please Trump, who thinks that the US does not have an inflation problem. And it's true, it doesn't have an inflation problem yet, just a little bit of a problem, because inflation in the US is still above the Fed's 2% target, but it could have a bigger problem in the future. That's the problem, because the tariffs are threatening. This being said, don't ever forget that lowering the interest rates alone is not a guarantee that the yields will fall. Because if the markets believe that there is a policy mistake, the yields could very well get disconnect from the interest rates and go higher despite rate cuts and rate cut expectations. That's called a loss of credibility. So prospects of lower rates, if they are not justified, is not necessarily positive news for sovereign bond space, because the US debt is exploding. Donald Trump's spending cuts on social welfare programs are well under the tax benefits to wealthy layer of the US population, the debt will actually continue to rise toward that $40 trillion scary mark, and the US should make sure that the global markets, global investors will absorb this additional debt to make rich Americans richer. The thing is, investors are backing off these days. There is a growing appetite for ex-US sovereign bonds, including the European sovereign bonds, with German and UK bonds in the first place. So in summary, Trump has power to do a lot, but he needs funding and he needs investor support. So investors will be saying the last word: invest wisely. For now, the US dollar remains heavily unloved by the investor communities. The dollar index continues to push lower despite Jerome Powell's cautiously hawkish tone at this week's semi-annual testimony before the Congress. But the weakening dollar supports gains in major US equities, as about 40% of the S&P 500 revenues come from abroad, with around 10 to 12% coming from Europe and around 8 to 10% coming from Asia. So the US dollar's depreciation or the other currencies' appreciation against the US dollar will have a boosting effect on revenues that the S&P 500 companies make outside the United States, because they will be higher in terms of US dollars when they are converted back to the US dollars at the end of the quarter. Yet a latest analysis from Bloomberg Intelligence that takes into account important factors like the treasury yields, the company earnings, and equity premiums actually warns that the S&P 500 earnings should rise as much as 30% in the next year for the actual price levels of the S&P 500 stocks to be considered as being fair. Is it possible? Well, it sounds stretched for the S&P 493 stocks, that's for sure, but not for the AI buddies. Micron actually announced yesterday a stronger than expected revenue and an upbeat forecast for the current quarter. Why? On the back of AI demand. In fact, the company's high bandwidth memory chips that are used in machines that develop and run AI tools are being sold like little breads, petit pain, as would say the French. And Micron actually says that it relies on growing need for more complex chips to grow bigger in the future. So Micron's share price actually doubled in value since the April dip, but it remains below last summer peak levels. So there is still some potential there for further gains. Elsewhere, Nvidia hit a fresh record high yesterday. The CEO Jensen Huang is now looking beyond the US and beyond AI to robotics, for example, to increase its market share, and Middle East and Europe could be the next big markets for Nvidia to close the gap that Trump's export restrictions toward China created in Nvidia's client book. But coming back to the S&P 500's overall performance, well, trade risks, the tariff risks loom, and they could eventually hurt appetite in the short run. So that's something that you should keep in mind. And speaking of that, Trump is now very, very angry with Spain that didn't want to expand its military budget to 5% of its GDP as did the other NATO nations this week. So the European stocks were down at yesterday's trading session. IBEX index underperformed its European peers because, well, Donald Trump now wants them to pay for the NATO disaster with higher tariffs, while the defense stocks in Europe rallied nearly 2% as the British Babcock announced its first ever buyback this week as a confirmation of the exploding demand for the European military spending. The company also raised its dividend and boosted its medium-term guidance, sending its stock price rallying more than 10%. It almost looked like a technology stock. The euro-dollar, on the other hand, traded past the 117 level yesterday, and cable surpassed the 137 mark. The next natural target for the euro bulls is the 120 level, and for cable is 140. And price pullbacks could be interesting dip buying opportunities to strengthen the long positions in the euro and the pound, not because the European economies are strong, but because spending plans are strong, especially for military and defense, and the US dollar is increasingly weaker. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.